All right. What is up, tycoons? What's up, traders? Super excited for today's video. We're going to talk about Google, the strongest tech company on earth. And going by its competitive position, Google is the strongest tech company on earth. It has high market share in most of its markets and practical advantages that could keep the high share going in several of them. Bing is not meaningfully eating into Google's search market share, and Google could lose share in search, long form video, and smartphone operating systems and still be dominant in those markets. Right. We're also going to use today's sponsor, which is Simply Wall Street, to go ahead and take a brief look at some of the fundamentals, give a nice overview of the stock, and dive, as I mentioned, into the fundamentals. There will be a link in the description and a pinned comment below that you guys can get a 14-day free trial and up to 40% off of your membership if you make a purchase on the Simply Wall Street platform. More on them later, okay? Before we move any further in the video, of course, the content provided on this YouTube channel is for informational and educational purposes only. It is not intended to be relied upon as legal, financial, or investment advice. Trading in any stocks, bonds, commodities, and crypto involve a significant risk of loss and is not suitable for all investors. So be sure to read through the full disclaimer, and we'll go ahead and get right into it using today's sponsor, Simply Wall Street. And if we look at a quick overview, all right, it is trading at 23.2% below the estimate of its fair value, and earnings are forecast to grow 12.94% per year. And there are no significant risks detected for Google from Simply Wall Street's risk checks. Now, if we look a little bit more into the fundamentals, all right. What I really love about the platform is if you're not good at fundamental analysis or you don't know how to really read some of the balance sheets or income statements or things like this, Simply Wall Street gives you some really nice graphs and visuals to help you really understand, the PE ratios and different things like that. So let's start off by looking at the price to earnings ratio versus the industry. And we can see that Google's PE ratio compared versus other companies in the US interactive media and services industry, Google is slightly higher in trading at a premium of a PE ratio of 26.6 compared to the industry average of 20.5, right? So some people may say it is overvalued from that perspective, right? Being that it has a higher PE ratio than the industry average. But if you take a look at its PE ratio versus its peers, we can see that Google, all right, the peer average is about 44. And we see that Alphabet, all right, Google is at 26.6. So from that point, it is a good value based on its price to earnings ratio compared to its peer average. And you look at the share price versus its fair value. And for this, they use a discounted cash flow model. And it is currently 23.2% undervalued with a fair value of roughly $159.78. So Google is trading far below its fair value by more than 20%. And when you take a look at the PE ratio, versus its fair ratio, and Google's PE ratio compared to its fair PE ratio, this is the expected PE ratio taking into account the company's forecast earnings growth, profit margins, and other risk factors. Its current PE is at 26.6, and a fair PE would put it at 36.8. So Google is a good value based on its price to earnings ratio compared to the estimated fair price to earnings ratio. So what I want you guys to do is use the link in the description or the pinned comment below, download the Simply Wall Street app or go to their website and start using the platform now, okay? And what I want you to do is not just look up Google, look up your favorite stock or maybe a stock that you're thinking of investing in right now. Maybe it's Tesla, maybe it's NVIDIA, maybe it's a small cap stock, or maybe you're into biotech or other things like that. Simply Wall Street is going to give you guys a really good breakdown of the fundamentals of a stock. And is a really nice platform. And remember, you can get a 14-day free trial to use it and research some of your favorite stocks, as well as the first 100 people to join will get up to a 40% discount on their purchase. Now we'll go ahead and move forward in the video and get back to Google. All right. So Alphabet, hereafter referred to as Google, has been rising lately. And we've been trading this one in the Discord. It's been one that we've been looking at. And back when it was at 100, we said there's a strong chance it could go to 120. And we did reach those levels. Its most recent earnings release was a minor beat, though it didn't move the stock much initially. What really got things moving was the company's efforts in artificial intelligence. Google recently put off an AI event that was much better received than its previous one, which showcased the company's Bard chatbot making an error. Ever since the second, more successful AI presentation, Google stock has been rallying. And That's largely in part due to the AI bubble that's forming right now. Anything related to AI, anything that speaks about AI or talks about AI is raging right now. And it's the new hype, it's the new bubble forming in the market. And I'm not saying that that bubble is about to pop, but rather that the AI bubble is really just beginning. Now, what should shareholders make of all this? Well, first things first, I don't believe that the massive amount of money being piled into companies that mention AI on earnings calls is being spent well. I think that Nvidia is way too expensive right now, and I think that other tech companies are getting pricey too, albeit to a lesser degree. Now, Nvidia, I really, really like that company, but when you take a look at, some of the fundamentals, right? From a fundamental standpoint, that stock is just extremely overvalued right now. But that doesn't mean that the stock can't go higher. But if you look into that, Nvidia might actually be the most fundamentally overvalued stock right now in the market. But there's tons of growth there, all right, and the potential with AI. Now, however, I actually don't think that valuation of Google has reached is ridiculous. Even though recent buyers have been buying for questionable reasons, going by multiples, Google is only slightly more expensive than the S&P 500, which now trades at 22 times earnings. Many other big tech companies trade at far wider premiums to the benchmark. For example, Nvidia is currently trading at 29 times sales and 95 times earnings. That's kind of what I was just briefly mentioning before. If you're going to buy a stock that have been swept up in the AI mania of 2023, then it would help to buy one that at least isn't at a ridiculous valuation. And I think that logic applies to Google here. The company is being valued fairly richly, but not at a level where the current valuation defies logic. Furthermore, Google still has positive revenue growth, and its earnings did not decline by large percentages last quarter. These signs collectively suggest that it is a stronger company than some of its competitors are. However, it is really Google's competitive position that argues for it being a good value today, and that's what we'll spend most of the time talking about. Now, the big reason, for thinking that Google is at a reasonable valuation today is the fact that it has a strong competitive position. And we can see this Twitter post right here talking about how Google is insanely strong. And let's say Bing's chatbot is better than Bard. Well, okay, Google's core search is still 10x better.
To get started.
Wow, that's funny. Shout out to my Google Home. It just started going off. I'm saying Google so much. But let's say Instagram or TikTok beats YouTube in shorts, okay? But YouTube still dominates long form video format. And it's a very competitive landscape, okay, and they have a really strong position. All right, that's essentially what we're highlighting there. If we move forward some more, Bing's chatbot was seen as a competitive threat to Google until very recently. It is built on ChatGPT. Only unlike ChatGPT, it has internet access and can deal with current events. This was seen as a major competitive threat to Google recently because Google is used to retrieve information, and Bing also retrieves information with an AI twist. AI is very popular today, and the mere fact that Bing was combining AI and search was enough to get people worrying about Google's market share. Fortunately, Google has not lost any market share. Bing's market share peaked in October 2022. Google has made slight gains on it since then. Google still controls a full 86% of the market. As the following chart from StatCounter shows, Google search market share has been growing for more than half a year. And that's what we're looking here, the desktop search engine market shares worldwide. Okay, and we can see that Google is right there around 86% of the full market. The empirical data does not support the idea that Bing is an imminent competitive threat to Google. However, let's not rush to conclusions. Perhaps Google bears a right and Bing will eventually beat Google Bard in the battle of the chatbots. That may in fact happen. Bing is getting better early reviews than Bard, but that doesn't change the fact that Google is holding its search market share. Perhaps these chatbots aren't as crucial to search as we were led to believe. If so, Google may have an opportunity to quietly push Bard aside, keeping people on the core Google search product without assuming the high costs that come with running chatbots. It's a similar story with video. YouTube is currently number one in video online with a 75% market share. Frequently, we've seen TikTok and Meta platforms Instagram described as competitors to YouTube, and they are in part, but only in short form video. TikTok and Meta both typically feature short videos with the average Insta reel coming in at 7 to 15 seconds. They might take some eyeballs away from YouTube here and there, but they just aren't competing with YouTube's bread and butter, which is long form video. The average YouTube video is 11.7 minutes long, which is far longer than what you'll find on Instagram and TikTok. So if you're looking for interviews, video essays, and full music videos, you're on YouTube. That portion of the online video market, Google/YouTube has on lock. Now, finally, the smartphone operating system market. Google is technically number one in installs there, although Apple is number one going by revenue, as the App Store generates more sales than the Play Store does. Apple dominates the wealthy US market, where people are more willing to spend money on apps than in the less developed markets that Android dominates. The point here is that Google has the low end of the smartphone market locked down and seemingly always will. There are no cheap phones in Apple's iPhone lineup. The iPhone starts at $799. As long as people want smartphones for less than $800, there will be a market for Android phones. What all this comes down to is the fact that Google's biggest competitors could make gains on it and Google would still be strong. Bing could defeat Bard, yet Google search as a whole would still be the number one search. Insta and TikTok could dominate the short form video market, yet YouTube would still control the long form video market. iPhone could strengthen its position in premium phones and Google would still be on top in budget phones. Google has so many advantages and it isn't that hard for it to remain a very profitable company. And that's not even talking about Google Drive, Gmail, and the newly profitable cloud system. Okay, so that pretty much is going to sum up today's video. We can take a look at the valuation right here. We kind of briefly did via Simply Wall Street. Okay, and we kind of already did that, so I won't cover this too much right here. There is one risk to watch out for. All right, as we've seen, Google has an incredibly strong competitive position and is not particularly richly valued. Depending on whether it can get its positive earnings growth back in the next few quarters, its stock may continue rising. However, there's one risk that investors will want to watch out for: the antitrust risk. Okay, Google has a very strong competitive position and it often gets sued because of that. The DOJ is working on a lawsuit against Google as we speak, and the company recently got sued for $4 billion in the EU. Google already lost one appeal against that ruling, so there aren't many appeals left before it's finally forced to pay out. When a company has as many dominant subsidiaries as Google does, it tends to attract the scrutiny of regulators, so investors will want to watch out for Google's antitrust risk. Nevertheless, Google is a great stock overall. The company has a very strong competitive position, and the valuation is not that bad compared to most large tech companies these days. I'd say I'd continue holding Google stock for the foreseeable future. Now, appreciate you guys watching. Smash that like button, subscribe to the channel. Don't forget to use today's sponsor, Simply Wall Street, via the links below in the description or the pinned comment.